Picture this. Maxie gets home from work. It's Tuesday night. He's still in his work clothes. Jacket on the chair, tie loosened, shoes still on. He makes himself a coffee he'll forget to drink. He opens his laptop, one tab, a loan application, 4 days old. Tonight, the decision came through.
He got rejected. $25,000. That's all he asked for. He had clients. He had a plan. He had the numbers. He just needed a bridge, a few months of runway to leave his job and go full-time. The bank said no. Same night, same bank. He checks his email. Pre-approved offer. $38,000. Auto loan. No business plan. No projections. No questions. Just his salary, his credit score, and a yes.
That easy done. The car they want to sell him will lose half its value in 5 years. The business he wanted to build was already making money. Same bank. Same night. $38,000 for the thing that loses value. 0 for the thing that builds it. And here's what you need to understand before we go any further. This is not bad luck. This is not an edge case. This is the system working exactly the way it was built to work. And once you see the math behind why, you will never look at a loan offer the same way again. Maxie makes $72,000 a year, solid salary, responsible with money, decent credit. He had been running a consulting side project for 8 months. 2 clients, $2,500 a month, consistent. He knew if he went full-time, that number would triple within a year. He just needed $25,000 to cover his expenses during the transition, to buy the basic tools. He had done everything right. And the bank still said no. But here's the part that should stop you cold. It's not your fault this feels normal. You've been inside this system your entire adult life. A credit card showed up when you turned 18. The car financing conversation happened in your early 20s. The mortgage talk came in your late 20s. At every single step, someone handed you a product and called it responsibility. Nobody handed you a capital application. Nobody pre-approved you for ownership. Nobody sent you a letter saying, "We see your potential. Here's a shot." The system has only ever offered you one type of debt, and it is not the type that builds anything. Stay with me, because the math we are about to walk through is going to reframe every financial decision you have ever made. If any part of that felt familiar, stay with me. The math is where this gets impossible to ignore. So let's start with what Maxie sees on the surface. The bank is offering him $38,000. No questions, no plan required, just a W-2 and a yes. And when Maxie sees that offer, part of him feels something. More like relief, like at least something is saying yes to him tonight. That feeling is not an accident. We'll come back to it. But first, the visible cost. $38,000 loan, 6.5% interest, 6 years. Monthly payment, $638. Total paid back, $45,900. Interest alone, nearly $8,000 for a car that started losing value the minute it was manufactured. And here is the number most people never actually run. A car loses roughly 55% of its value in 5 years. That $38,000 car is worth maybe $17,000 by the time the loan is paid off. Maxie paid $45,900. The car is worth $17,000. That is a $28,900 loss, not a purchase. A $29,000 wealth transfer from Maxie's future to the bank and the dealership.
Pre-approved in minutes, but here is where it gets brutal. That same $38,000 invested instead of financed at 7% annual return compounded over 30 years. It becomes $289,000. Think about that.
When Maxie ran that number, he went quiet. He said, "I always thought of it as a monthly payment. $638 felt manageable. I never once thought of it as a $289,000 decision." And that hit hard.
That is exactly how the trap works. It shrinks a generational decision down to a monthly payment. So small it feels responsible. Remember what Maxie actually wanted the money for. $25,000. A consulting practice already generating $2,500 a month, 2 real clients, a real plan, conservative projection, $5,000 a month within 12 months of going full-time. That is $60,000 in additional annual income. On top of his salary, $72,000 plus $60,000, that is $132,000 in year 1 alone. The bank said yes to a $289,000 wealth loss and no to a $60,000 annual income gain. That is not a lending decision. That is an architectural choice built long before Maxie ever walked in. Now here's the psychology, why it feels right even when the math is this clear. Maxie used to believe that getting approved meant he was doing well, that a pre-approved offer was the bank saying, "We trust you, you've earned this." He had internalized approval as validation. That feeling kept him from asking harder questions. But the approval was never about him. It was about his W-2. The bank does not care whether a car improves Maxie's life. They care that his salary is a guaranteed payment stream for the next 6 years. The system is not built to assess risk. It is built to assess predictability. Those are completely different things. Risk assessment asks, what is the probability this investment generates a return? Predictability assessment asks, does this person have an employer who will sign their paycheck every 2 weeks? A business loan is dangerous to a bank because if Maxie succeeds, he stops needing them. He builds equity. He generates his own cash flow. He becomes financially independent. One less customer on the hook. A car loan is perfect for a bank because the car loses value, keeps Maxie financially stretched, guarantees he comes back. Another loan, another payment, another 6 years. This is where the trap locks in. Financial data shows the average household carries simultaneous debt, mortgage, car note, credit cards, for most of their working life. Total interest paid across a lifetime, around $420,000 per household. If that same money had been invested at 7% annually over 40 years, it becomes over $3 million. $3 million, not taken by force, transferred voluntarily, because the system made borrowing for consumption feel like responsibility. Maxie sat with that number for a long time. And here's the consequence that never shows up on any monthly statement. It is not just money. It is time. Every month spent managing payments on things that lose value is a month not spent building something that generates income. Every single month, the bank will finance a jet ski. They will extend your credit limit after a promotion. They will send a pre-approved offer the same night they reject your business plan. But capital for ownership? For something that might actually make you independent? We regret to inform you.
Quick thing, if this is landing, subscribe. The next video exposes an even deeper layer of the same system. You'll want to see it.
The programming runs so deep, Maxie almost didn't apply at all. Part of his brain had already decided he wasn't ready, not established enough, needed more time, more proof, more history. He had talked himself halfway out of asking before the bank ever got a chance to say no. He had accepted the ceiling before anyone imposed it. And that, honestly, is the most elegant part of the design. The system does not just block access to wealth-building capital. It trains you to stop wanting it, to feel grateful for the car approval, to measure your financial health by how smoothly you are managing your debt instead of how much you are actually building. The trap is not the interest rate. The trap is the belief that the interest rate is your biggest problem. Maxi did not take the car loan. He kept his old car, kept his job, kept building on nights and weekends, client by client, no capital, no approval, no green light from any institution. It took longer than it should have. 2 years instead of 6 months. That extra time, that is not a personal failure. That is the cost the system charges people who do not start with inherited wealth. A real cost, worth naming clearly. But he got there. He runs his practice full-time now, makes more than double his old salary, has equity in something he built, has income that is not capped by what one employer decides his time is worth. And last month, that same bank called him, not to offer a business loan, to offer wealth management services. They want to help him invest his money now that he has money, now that he built it entirely without them. He did not take that call. Here is what I want you to sit with. Maxi is not exceptional, not unusually disciplined, not brilliant, not brave. He simply saw the math clearly enough to stop believing the ceiling was real. He stopped asking, "Can I afford the payment?" and started asking, "Does this build something I own?" That is the entire shift. One question, replaced by a better one. Millions of people right now have a pre-approved offer in their inbox and a business idea they have been quietly talking themselves out of for months. Millions of people are managing their debt load instead of building assets. Millions of people have accepted the bank's definition of responsible as their own personal financial philosophy. And the math says that belief costs roughly $3 million. Your salary is not your ceiling. It is the current market price for your time, set by one buyer, one agreement. That can be renegotiated, that can be replaced. The moment you build something that generates income independent of your hours, the entire equation changes.
The bank needs you to believe your salary is your limit, because as long as you believe that, you need the bank. The moment you stop, the architecture loses its grip. Maxi closed that laptop at 7 p.m. on a Tuesday, rejection email on one tab, car loan offer on the other. He chose neither. He just kept going. That is all it takes. Not more money, not a perfect plan. Just the decision to stop letting an institution that profits from your debt define what is possible for you. The ceiling was never real. Maxi just lived the proof. If this shifted something for you, the next video goes even further. The system has more layers than this one, and now you are ready to see them.